On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hi guys, thanks for joining us this evening. My name is Lyndsen, although a lot of people call me Lindsay. And I'm going to talk to you guys today about common trading misconceptions. So these are things that people think about trading that are not quite correct, or in some cases just flat out incorrect. I think it's personally, I find it a very fascinating topic, but I think it's something that's quite under-discussed in trading literature. So this is in materials that try to help people become better traders, webinars, just teacher-student lessons. I think it's something that is quite important, but is not discussed enough. So I know a lot of you are quite busy and you've taken time out of your day to come and join us this evening. So in return, what I'll do is try to make this as relevant and engaging as I possibly can. Now, what I like about the way the team positioned this is that they said it's not going to be textbook theory. And this is something that I find quite important for this particular topic. And there's a few reasons for this. Firstly, I just didn't find my finance seminars in uni that interesting. Some of my law ones, sure, but the finance ones, generally quite dry. I think this topic is not going to fall under that category. Secondly, there's so much stuff out there on the internet that you can read when it comes to traditional textbook theory, trading, economics, and that sort of thing. And I think if I spent the time today discussing those and discussing things that you guys could easily read for yourselves and probably already have read for yourselves, it just wouldn't be a good use of either of our time. But the most important reason that I don't want this to feel like a seminar is because it's just not my competitive advantage. So traditionally, I'm not a content creator. I'm not a public speaker, as you could probably tell. I've always been a trader or an investor. That's what my career background is. And I will go a little bit into detail on some of the things that I've done previously, but won't spend too much time on it. But one of my competitive advantages is that I've had a relatively unique career path and experience set when it comes to Forex and CFD trading, at least the people within that sphere. So all of the discussion points that I picked today, they've been handpicked based on personal experience. All of the examples are original examples. All of the anecdotes that I tell, if I say this is something that I saw, this is something that I actually did, these are all true. So I'm going to try to play into my strengths as much as I can. So I want today to feel a lot more like a conversation than a lecture. And there will be time at the end to ask questions. You can actually type questions now as we're going into, I think it's on your right-hand side. You can type questions into that chat box and I'll be able to see them and I'll get to some of those as we get to the end. So let's move on. So as I said, this won't be traditional textbook theory, but something else it won't be is it's not going to be a get-rich-quick seminar, but not for the reason that a lot of you will think, because the first bit, get rich, is actually something that is possible from trading. We've seen it happen many times before. It's something that I personally think is very possible. It's the second bit. So I've got a few ex-colleagues who have attended trading seminars in the past. These would be the sorts of things that might go for 4 to 6 hours in a day. Maybe they go across 1 or 2 days and potentially forking out thousands of dollars to attend these. And all of them, every time, have said, bit of a waste of time, waste of money. I didn't really get anything out of it. Now, this is not necessarily because of the caliber of the speakers. I don't really know what the credentials of those speakers were, but I'll use an example. So you would have seen the ad at the start of this talk. The Phoenix Suns are in partnership with Anzo Capital. So I'll use an NBA example. So from the generation that I grew up, our greatest of all time is Michael Jordan. If you're a little bit younger than me, you might think it's LeBron James. If you're older, it'll be Kareem or someone else. Maybe some of you think it's Kobe Bryant, but anyway, we'll use Michael Jordan. If I had the opportunity to listen to Michael Jordan talk about basketball, say for 4 to 6 hours across 1 or 2 days, I would absolutely jump at that opportunity. I don't know if I'd pay thousands of dollars for it, but I would absolutely take it. But at the end of that 1 or 2 days, how much better at basketball do you think I would be? And I personally don't think I would be much better or any better at all. And I actually do have some sort of base in basketball because I'm interested in it. And I did play competitively for over a decade when I was younger. And the reason is, what it ignores is the amount of time that he put in and the amount of time that you would have to put in order to get better at that particular thing. So I think one thing that's really underestimated in the expert's journey, or what I'm going to call the expert's journey, one thing is just the amount of time it takes to become an expert. So when I think of investing, I think of Warren Buffett. And when I think of trading, I think of the hedge fund manager Ray Dalio. But this applies to all aspects. You can think of Michael Jordan in sports. You can think of the Beatles in music. One thing they all have in common is the amount of time they put in. And the other thing that they put in, or they experienced a lot of, that people don't think about, is mistakes. So quite often, the person who is the foremost expert in a particular field is also the one who's just made the most mistakes. And I know that sounds a little bit counterintuitive and a little bit weird, so I will qualify what I've just said. Generally, what they've done is they've made a whole bunch of different mistakes, and they've only made each mistake once. So obviously, if somebody's going in and continuously making the same mistakes, this is not great. They're probably not an expert in that field because they're not learning anything. But people like Buffett and Dalio have probably made all the mistakes that you can think of. And that's why when you listen to them speak now, it seems like they have all the answers. It's because they've seen so many different scenarios. They've made all the mistakes before you got a chance to speak to them. So they know what not to do. They know what not to say. So those are two things that I want you guys to keep in mind as well, that you can get rich from this, but it won't happen just like that. But it actually can happen much quicker than you think. But there will be time and there will be mistakes that go into it. So why did I pick trading misconceptions and fallacies? So the primary reason is I think it's a useful topic because it's applicable to every single stage of your trading journey. So I know there's a lot of different people who have joined us this evening, and you'll all be at different stages of your trading journey. Like some of you might be just starting out. Some of you might be relatively established traders who are trying to pick up some tips. And I wanted to pick a topic that would be applicable to everybody. And this is one that definitely fits that criteria. So these topics, the things I'm going to speak about, are things that I personally have to think about as well and remind myself of, because it's very easy to fall into these traps if you get complacent. So if you can recognize and avoid the topics that I'm going to discuss today, it will align you closer to your ideal trading path. So if you try to imagine that if you trade optimally and that path is dead straight ahead, that every time that you have a trading misconception, you're going to be facing slightly to the left or slightly to the right. And I would consider this a successful session if I can help you realign yourself onto that path, even if it's just one thing that I say that you either didn't realize before or that you had forgotten, and it puts you back on the right path. I think that would be a successful discussion topic for today. So I said that I'd discuss this briefly. This is just so you can adequately judge whether you think I'm worth listening to. I'm not going to rattle off absolutely everything, but most of my recent experience comes from the retail trading space, which is the space that we're in right now. So I've worked at various Forex and CFD brokers. I was the head of trading at different Forex brokers. And it involves a lot of things, but the one that's probably most relevant for our purposes this evening is I've had the experience or the ability to look at a lot of individual trading accounts. So I've looked and analyzed trade by trade, different retail trading accounts. I've seen what is successful, what is not successful. It would be in the hundreds. And I don't like exaggerating or using hyperbole, but it's possible that it's in the thousands as well. I don't want to say that because it sounds like a lot, and it is, but it's easily in the hundreds of trading accounts that I've looked at over the past decade. Now, unlike a lot of people who go into the trading side at Forex brokers, I actually didn't start from the sales or the customer service side. I actually started in trading in a different arena. I was in quantitative trading at a firm called Susquehanna International Group. So they're primarily options market makers, but they cover every single asset class. And if you keep up with financial news, you might have heard of them. They're quite often quoted in Bloomberg or Reuters articles. If you're interested in poker, actually, you might have heard of them as well. They've produced multiple World Series of Poker bracelet winners, and their founders were initially professional poker players. And as part of our initial training, I had to have a poker lesson every single week. So every single Wednesday morning before the trading day started, we had a lesson with a former World Series bracelet winner. So what I got the most out of Susquehanna that's relevant to this is a lot of my trading theory, gambling theory, and interestingly, poker theory and game theory came from that. So the way I think about trading came from my time there. And if you go back far enough, before that, I actually started my career out of uni as an investment banker. So I was at Macquarie Group, which is the largest investment bank in Australia. I was in M&A, so mergers and acquisitions, so traditional corporate finance role. And what I got most out of that was my understanding of macroeconomics. So I guess my fundamental analysis would have primarily come from that role. So what you can see here is that what ties all of my experience together is my relative strength in numbers and numeracy. So I didn't have the most direct path to trading. I actually started in investment banking, moved into trading, and then found my way into the Forex broking side. And also something that you'll notice is that these were all non-sales roles as well. So I was always either the person or one of the team responsible for trading profits or investment profits. So let's get into it. Trading misconceptions. So just in general, a few high-level comments. It's one of those things that's simple but not easy. So what I mean by that is they're very simple for me to state, and when I talk about them, it will be easy for you to understand what I'm saying. But that doesn't mean that they're easy to actually follow. Or in our case, what we want to do is you want to get on top of them and master them. So they're simple to state and explain. They're not easy to master. And one of the reasons is, interestingly, it's often a part of human nature to make these mistakes, or it's built into conventional wisdom to make these mistakes. And you'll see what I mean when I start talking about them more. Second thing is the Pareto principle, which sounds a little bit fancy. All of that is the 80-20 rule. So the 80-20 rule, for those of you who are not that familiar, it just means that most inputs and outputs aren't linear. So let's say you have a goal that you want to get to, and you have to complete 100 tasks to get to that goal. Quite often, if you just complete the first 20 of those tasks, you will get 80% of the way there. And then it takes you the other 80 tasks to complete the remaining 20%. Or if you look at a particular area, maybe 20% of the wealth is concentrated. 80% of the wealth will be concentrated in 20% of the people. Although I guess nowadays it's more like 80% will be in 1% of the people. But in this case, what I mean is, if you just take care of these three topics that I'm going to discuss in a second, it will actually take you a long way to becoming a decent trader. And I honestly believe this next statement: if you can get on top of these three, you will be an above average retail trader. Remember, I've looked at hundreds, if not thousands, of trading accounts. And I think I am in a position to say, if you can get on top of these three things, you will be an above average retail trader. The final thing is really not that important at this stage, but many of them are interrelated. It will become obvious as I start talking about them. So let's get into them. The first one. So for all of these, don't worry too much about the title that you see. So I've called this one Momentum Trend. What's more important is that you focus on what the misconception is, so the mistake that a lot of people make, and then the key tenet is the correct way to think about this particular topic. So the first one is, what a lot of people think that is not quite right is that an asset whose price has fallen is cheap, and an asset whose price has risen is expensive. So this is the fallacy or an incorrect way of thinking that gets a lot of people into trouble. So I'll start by telling an anecdote with an ex-colleague. I won't say her name, but she was in the finance industry, but not from a trading background, but definitely not a dumb person. She'd worked at one of those financial data companies like Bloomberg or Thomson Reuters. It wasn't either of them, but I can't remember exactly which one. But she'd worked in their New York or Boston office before. We were looking at a chart with some price action. I think it was just a straight up stock, so equities. And she said, "Oh, I think this particular stock is a sell." So of course, my next question was, "Oh, that's interesting. Why do you think that?" And she said, "It's trading above its true value." Of course, the next question then is, how do you know what its true value is? What is its true value? She said something very interesting. She said, well, yesterday, so let's say right now it's trading at 50. She said, yesterday it was trading at 40. So that's its true value. Now, of course, alarm bells started going off in my head, and I just had to think of a way of explaining why this was not quite the right way of thinking of it. And it really wasn't that hard. All I had to do was go back in time on the chart and point her to a day, maybe about a week earlier. And I'd say, okay, but if I'd ask you this question on this day, it was trading at 50, but the previous day it was trading at 60. So if I'd asked you that on that day, you would have told me this is a buy because it's trading below its true value, because the previous day it was trading at 60. So you can see that, firstly, you can't just assume that the true value is whatever it was trading at yesterday, because today is going to be yesterday. I hope that made sense. But I think you all know where I'm going with this. She had fallen into the trap of this misconception. She had thought that because the price had risen, it was now expensive. And she would have applied the same reasoning in reverse. If the price had fallen, she would have thought it was now cheap. So instead of thinking of things as expensive and cheap, particularly in the trading space, like this might be more relevant if we were very long-term investors, or if we were valuing something from an investment banking perspective, but that's not the space that we're in at the moment. It's more helpful to think of the things in terms of exposure. So that's the point I've made in the middle of this slide. So the better way to think of it is to ask yourself, do I want to be long or short this asset? So of course, long just means that you've bought the asset, so you will profit if the price rises, and short is the opposite. It means you've sold it. It means you will profit if the price falls. So you want to think about, do I want to be long or do I want to be short? Rather than thinking of, is this cheap? Is this expensive? Now, I know it sounds like a very subtle difference, and it is, but the misconception, thinking of things as cheap and expensive, will get you into more trouble than thinking in terms of, do I want to be long and short? And the interesting thing to me is that if we take this outside the realm of financial assets, so if we start thinking about tangible goods, non-financial assets, we are actually not bad at thinking of things in the correct way. So I'll give you an example. Let's say I give each of us a plot of farmland. So we have a little orchard, and I give you two choices. You can either plant apples or bananas. And for our purposes, let's just assume that apples and bananas all come from seeds. They can grow in the same season, and it takes the same amount of time to grow them. I know some of you will probably know that that's not quite correct, but let's keep it simple. So let's say I give you this scenario. We start off with 50% apples and 50% bananas, and then we all go on holiday for a month and we come back. And we look at the price of both. We look at the charts and we see that apples have steadily declined in price over the past month, but bananas have steadily increased in price over the past month. what are you going to do now? Now, I know if you only think about it for a few seconds, all of you are thinking along the same lines. You're thinking, how can we reduce the amount of apples that we're growing and increase the number of bananas? So you're all thinking we need to go shorter apples and longer bananas. And some of you might go, well, let's go 60% bananas, 40% apples. Some of you might be more aggressive and go 80-20. Some of you might be thinking, let's just get rid of all the apples and only plant bananas. But either way, we all intuitively understand that we want to be more in the banana business and less in the apple business. And this actually makes perfect sense to us in this sphere. But for some reason, when we start thinking of financial assets, so these are, for the most part, numbers on a screen, and we can't see or touch the apple or banana, we're just abstractly thinking about a stock price or a currency pair. Our brains think of them not in terms of, do we want more of this, less of this? We think, oh, this is getting expensive, or this is now cheap. So the better way to think of it, again, is ask yourself, do you want to be long or short? And the key lesson is, do not go against a prevailing trend without a good reason. Okay, so I'll say that again. The key tenet for this particular misconception is, do not go against the trend without a good reason. Now, again, that sounds like a very definitive and hard principle to follow. So I will give two qualifications. Firstly, what trend are we talking about? The trend depends on the time frame that you're looking at. So if you're a very quick intraday trader, you might be looking at a trend that's based on a 15-minute chart, or even a 5-minute chart if you're a scalper, or maybe an hour chart. If you plan on holding things for a week or so, maybe the daily chart or the 4-hour chart might be more relevant. But a trend is based on the time frame that is most relevant to you. And the second thing is, again, there's no always, there's no never. There can be good reasons why you will go against this. But by default, if you have no reason to go against the trend, you should generally go with it. Now, this tenet is also still very compatible with technical and fundamental analysis. So I'm definitely not saying that you should throw that out. I still am a very strong proponent that fundamental and technical analysis have a very strong part to play in trading decisions. So I'll give you an example. Let's think in terms of going long, because that's the easier way for most people. So you're thinking about buying something. So you do your fundamental analysis, you look at macroeconomics, and you decide, you know what, this thing is going to be a buy. And you look at the price action, you look at the chart, and you can see that the price is approaching a support level. So for those of you who aren't that familiar, a support level is just a level in the price where it tends to bounce or not fall below that price. So generally, when the price approaches this level, it tends to turn around and head back up. So let's say fundamentals, technicals line up perfectly for this to become a long or a buy. You should wait and not actually hit that buy button until you see some evidence that you are correct. So I'll say that again. Even if you do your analysis and you've decided that this is a buy, do not buy this asset while the price chart is clearly falling. You want to give yourself some evidence, let the market give you some evidence that you are correct, because you might be dead set correct, but if the rest of the market still hasn't caught up with you, that price is still going to keep falling, and you are going to find yourself stuck with losses, at least for that initial period. Now, again, how much of a turnaround do you need to see? Totally depends on your trading style. So if you're a short-term trader, maybe you only need to see it turn around by 10, 20 pips, and that's enough. If you're a more medium-term trader, maybe you want to see it turn around by 0.5%, 1%. If you're a very long-term trader, you might even want to wait for 5%. That's probably not going to apply to most of you, but it's up to you and your trading style how much evidence you need. But you do want to have some evidence, because if you consistently try to catch things at the bottom, you might get it right once or twice, but the vast majority of time, you are going to get it incorrect, and you are just going to sustain losses in the short term. So the phrase that we use in the industry that you might have heard is you don't want to try to catch a falling knife. And on the other side, if you're trying to go short something that's continuously rising, you don't want to stand in front of a runaway train. So that's something that you hear quite a lot. And generally, you want to see some evidence that you are correct before you go long or short. So again, just because something is fallen doesn't mean it's cheap. Just because something is rising doesn't mean it's expensive. It can continue rising and it can continue falling. So generally, if you don't go against the trend without a good reason, and what's an example of a good reason? Quite often it's if you have like you might have the Federal Reserve announcement. So a very sudden binary change in circumstances. If you're doing insider trading, which I suggest you don't do, but if you have some sort of non-public information, obviously that can negate any sort of price action. But generally, if people say that they are continuously picking the tops and bottoms of charts, they are either lying or they're doing insider trading. And I would suggest that you don't do either of those. I'll finish with another anecdote. So I think this was in December. It was either October or December of last year. So my wife had some of our funds tied up in a basket of 10 tech stocks. So I'm going to think of it as the NASDAQ basket. It was the Magnificent Seven plus a few other stocks like Broadcom. And she was thinking of selling some because we needed to free up some liquidity for something else. And she asked, should I sell it now? Now, I didn't even know what the 10 stocks were, and I knew they were tech stocks. So without doing any further analysis, I was able to give her a quick high-level answer. And I knew that the market in the US had gone up over the preceding 2 days. And I also knew that there were no major news announcements until the following week's Federal Reserve announcement. So I said to her, all right, if you can wait, then don't sell it until you see at least one day that the market falls. And that is going off the same principle that I'm saying now. If the prevailing trend for the last 2 days is that the market has been rising, there is no reason to stand in the way and to try to go short while that's still happening. So that's a practical manifestation of the lesson that I'm trying to impart on this particular slide. And as it turns out, in hindsight, the market either stayed still or continued rising over the next 5 days. So we were able to continue riding that a little bit higher up. So this next one is one that I've called risk reward. And I'm going to start by explaining it from the perspective of poker. So I could do poker analogies all day, but that's maybe for a topic for another day. But one misconception that people have when they're thinking about poker or thinking about gambling in general is they think the aim of poker is to win the most number of hands, when actually the aim is actually to win the most money. Now, let that sit with you for a second, because they sound like the same thing and they're correlated, but they're not exactly the same. So if we bring it back to the trading realm, the misconception that a lot of people have is that the aim of trading is to win the most number of trades. So they think if their win rate is 70%, 80%, that's great. Now, in a vacuum, that is great. Obviously, winning more trades is going to help you win more money. But the aim that you guys have is not actually to win the most number of trades. What you're actually trying to do is you're trying to make the most money, make the most profit. I think if you can make a very good profit, you don't actually care how many trades it takes you to get you there. So I'll start by giving an example. Let's say you are conducting a trading exercise. There's you and two of your colleagues. So there's someone on your right, someone on your left, and you all choose to trade the same instrument. So for our purposes, let's pick a currency pair. Let's pick the euro against the dollar. It's the most commonly traded pair. And you all trade a similar volume as well. So we can compare all of your results. And at the end of it, whatever you choose to do, you make $1,000, which is great. Now, your colleague on your left manages to lose $1,000, so not so good. And the colleague on your right makes $10,000. So you've made 1,000, someone's lost 1,000, and someone's made 10,000. So someone from the outside may look at this and go, well, two of these traders made money, one of these traders lost money. So let's conclude that maybe that guy is not such a good trader, but these two are good traders. However, an established trader will look at this and see, well, actually, even though you made $1,000 on this particular trade, your performance is actually closer to the person who lost 1,000 than it is to the person who made 10,000. So I'll say this again. If you make $1,000 on a trade, you are actually closer in performance to someone who loses 1,000 than you are to someone who makes 10,000. And it's not really that hard to see why. So let's say you all do a second trade. It could be the same instrument, different instrument, but either way, it's something comparable. And this time you lose 1,000, so you're back even. And the guy on your left who lost 1,000 the first time, this time he makes 1,000, so he's back even as well. So now the two of you are in the same spot. That guy who made 10,000 the first time, he can lose 1,000 and he's still up 9. He could lose 1,000 again and still be up 8. He could go on holiday, and you would need to make 9 more trades that make $1,000 just to catch up to his one trade that made 10. So the whole point of this example is I want you to think about and recognize that the magnitude of the profit or loss is as important as whether or not the trade was a winning or a losing trade. So I'll say that again. The magnitude, so the size of the profit or loss, is as important as whether or not it's a winning or losing trade. So what I'm saying is that size matters. Now, obviously, this is only with respect to comparable trades. I'm not telling you guys to go out now and add an extra 0 to the volume of every single trade you make, because obviously, if you add an extra 0, then your profits are going to be multiplied by 10, but your losses will also be multiplied by 10. So that's not what I'm saying. What I'm saying is, for a given set of trades that are all comparable, the magnitude of the wins and losses is as important as whether it's a winning or losing trade. Okay, so how do you actually manifest this in reality? So how do you practically apply this? So every time you make a trade, what you should be thinking about, you should be thinking about two things. You should be thinking about, where can this go? So let's again use an example of a long trade. So you want to think about, how high can this thing rise? So the answer might be 1%, 2%. If you're a short-term trader, you might only think it's going to go up by 50 basis points. It doesn't really matter. You want to think about where you think this particular stock or currency pair can go. What you also want to think about, and I would say this is actually more important, you need to think about, at what point do I admit that I was wrong and cut the position, accept the loss, and just live to fight another day. And if you look at those two numbers, the amount of profit that you're going for should be bigger, and in fact should be much bigger than the amount of loss that you're willing to accept. Okay, so what I mean by that is, let's say you are going to cut your losses if you lose 50 basis points or 50 pips, so 0.5%. If this goes 50 basis points against you, you're going to admit, okay, I was wrong about this one. Let's try another trade. If that's the case, you should ensure that the amount of profit that you're going for is at least 50 basis points. And if you can do this consistently, you're going to make your life a lot easier. So to use the MT4 jargon, your take profit amount should be at least as large as your stop loss amount. And preferably that first one, your take profit, should be significantly larger than your stop loss. Okay. I'll finish with an anecdote from one of the earlier trading firms that I worked at. So I was a senior trader on the desk, and I was on shifts. This was when I was doing shifts during the European and US sessions. And I was on shift with a junior trader, and he had placed a couple of trades himself just to practice the night before. So I was reviewing them. I was curious how he was thinking about them, see if there's any advice that I could give to him. And he had placed 2 trades the night before. One of them had made money, one of them had lost money. The trade that made money, he had made 8 pips. So it's not huge, but it's still something. He had made 8 pips on that particular trade. But the trade that he lost money on, he sustained a loss of 25 pips. So he made 8 pips and lost 25 pips. So after reviewing the trade, asking him, what were you thinking here? Why did you do this? Blah, blah, blah. The last thing I said to him was, well, you need to think about the size of your profits and the size of your loss, because this really should be the other way around. Because if you keep making 8 pips at a time when you win money, but you lose 25 pips every time you lose money, you need to be correct 3 times as often as you are wrong just to break even. So he needs to bat 75% just to break even. And that's something that is not that easy to do. So I've got a friend who's a portfolio manager at one of the major funds that's based here in Sydney, but has a lot of international positions. But what he said to me the other day, and this is something that I've heard throughout my career as well, is that most fund managers, they're happy if they can get 54, 55% of trades correct. So that's clearly above 50%, but it's not as high as a lot of people might think. A lot of people might think, well, the absolute best stock pickers are going 70, 80%. It's really just not the case. If you can just get a little bit of edge, a little bit more than 50%, that is quite often enough. And how can these funds or these traders be so profitable only getting 55% correct? It's because when they're correct, they are very correct, and the size of their profits is much larger than when they are incorrect, when they're wrong, and the size of their losses is relatively smaller. Okay, so again, the aim of trading is not to win the most number of trades. You are trying to make the most amount of money. And in order to do that, you need to understand and recognize that the size of your wins and the size of your losses is just as important. So it's a hard thing to do, but if you have a winning trade and you make $1,000, but everybody else who made a similar trade made 5,000, 10,000, you should be a little bit disappointed in that outcome. Like, it's always great to make money, but if you leave money on the table, that's the phrase that you'll hear a lot. If you don't make as much as you should have, you should be disappointed in that. And vice versa. If you make a trade and you happen to lose, but you only lose 1,000, but everyone else who made a similar trade lost 5,000, 10,000, 20,000, you should actually be very happy with that outcome, because you managed to lose the minimum amount from that. And again, it's very hard to do because no one likes to lose money, but you really do need to think about the size of your losses and the size of your wins. Now let's move on to the last one. So I've called this one unrealized or floating P&L. Now, before I go into the misconceptions and the tenets, I will start by telling a couple of anecdotes. So around the time I was thinking of moving from investment banking into trading, remember I started my career as an investment banker. The first time I ever spoke to a recruiter, the lady I was speaking to had spent some time on a trading desk. So at the end of the interview, I asked her, what was the most important lesson that you learned during your time in trading? And the answer that she gave me was one that stuck to me to this day, and I think it's still very, very relevant. And what she said to me was, most people don't cut their losses quickly enough and don't hold their wins for long enough. So I'll say that again. Most people are too slow to cut their losses, and they're too quick to take their profits. Now, you can see that I could have easily told this anecdote during the previous topic. So remember, I said a lot of these misconceptions are interrelated. Now, I'm going to come back to that particular statement in a second. I'll tell you another anecdote. So one of my earlier Forex brokers that I worked at, it was owned by, it was a Chinese businessman, had bought the license and set up the office in Sydney. he had made his money in something that was not trading. It really had nothing to do with finance. I think he probably ran a factory or something in one of the provinces in China. So you probably heard a similar background story before. So one day he came into the trading room and declared to the trading desk, he was essentially boasting, but he declared to the trading desk that he placed a few trades a couple of days ago and he was already up $17,000. He was already up 17 grand. And of course, we're a little bit skeptical, but also just listening to him. He walks out of the room. And of course, the first thing that we all do is we opened his trading account and checked whether or not he was telling the truth. Now, he had an MT4 account as well. So his trading account, the layout will look a lot like what you guys are used to. So we had a look and he was telling the truth, sort of. So if you remember your MT4 accounts, if you go to your trading history, it will be separated into two parts. So the first part in the top half will be all of your historical trades, where you entered, where you exited, and what your P&L was. And then below the line, so the bottom half, it will be all of your open positions, where you got in, but of course you haven't closed them yet. So above the line, he had indeed made 17 grand. He'd made a series of trades. He'd gotten most of them correct, and he was up 17. Now, what he had conveniently forgotten to tell us, or he had forgotten himself, more likely he just forgot to tell us, is that below the line, he had a whole bunch of open positions that were all losing positions, and he was down about 40 grand. So he was down about 40,000 in all of his open positions. So his overall account was clearly in the negative. He'd made 17,000 from realized profits, but he was down 40,000 in unrealized losses. And I don't know if it was a misconception or if he just thought that we weren't going to check his account, but let's assume it was a misconception. So the mistake he made was that he thought that unrealized profits and unrealized losses were not real. And this is a mistake that a lot of people make as well, whether they're trading equities, whether they're trading currencies, any asset. So the thing that I want you guys to remember, so the key tenet is unrealized or floating profits are still profits, and unrealized and floating losses are still losses. Okay, so that's important to remember. So try not to think of things in terms of whether they're realized or unrealized. Just think of them as profits or not profits, because they're all really the same thing if you think about them correctly. And I can give you an example that will show you how ridiculous it is to think of them in a different way. So let's just pick any currency pair. Again, let's just use the euro. And we can pick any volume amount. So let's say we pick 10 lots, so that's €1 million. I can guarantee a realized profit in a euro trade if you give me a month. I mean, you could give me an hour, you can give me a week, whatever it is, but let's use a month in this case. So here's how I'll do it. I will open up my MT4 account, put in the volume, so 10 lots, 1 million, and I click the buy button. And immediately after, I click the sell button. And then I just go on holiday for a month. Now, what happens when I do that? So those of you who have done enough trades will understand that you will now have two lines in your MT4 account. You'll have an open position, buy 10 euro, and below that you will have sell 10 euro. I come back in a month. Now, let's say the euro has risen by 50 basis points, so 0.5% in that time. So I will have a long position that has made $5,000. So what I can do is simply click the close. So I'll double click that, close the trade. And now, hey presto, I have a $5,000 realized profit above the line in my MT4 account, in the same way that the owner of this firm that I talked about had a $17,000 worth of profit above the line. So I've made $5,000, but I haven't really, because I also still have an open sell position below the line that I haven't closed yet that is losing $5,000, which makes perfect sense because at the start of this, I clicked buy and sell at the same time. So I've really done nothing if you think about it. All I've done is cross the spread and cost myself some commissions. But you can see that if you don't look or think too hard about it, I can tell all of my friends that I made a trade, it made $5,000. I can show them the account. I have a 100% win rate because I've made one trade and it made money. But it conveniently fails to mention or recognize that I also have an offsetting loss as well. So even though I have a realized profit, I also have an unrealized loss, which is equally as important as the profit that I've made, of course. And I think it's very easy for you guys to see in that ridiculous example that I've used why it's important not to sleep on the unrealized gains and losses that you had. Now, again, this misconception, this tenet, there's a causal relationship between this one and the prior two that I spoke about. So if you remember the anecdote I told 2 slides ago with my wife and the NASDAQ basket, we had an unrealized win or unrealized profits on that. But I told her not to sell any stocks in the basket until the market had a down day. So just because we didn't sell them doesn't mean we weren't still in profit. We were still in profit and we didn't need to realize it straight away, but it doesn't make those profits any less real. If you, again, you think about the anecdote I told in the previous slide with the junior trader, one of the reasons he had trouble selling before he lost 25 pips is because he didn't want to make that loss real. He saw it fall by 10 pips, 15 pips, 20 pips. Maybe he was sitting there crossing his fingers, hoping it would turn around, but he thought if he didn't click the button and close the trade, it wouldn't be real. And vice versa, when he made the trade that actually went up and made profit, he wanted to make it real. He wanted to feel real. So what he did was he closed the position when it had only made 8 pips. And again, this is why so many people fall into that trap. Remember the story I told at the start of this slide with the recruiter. People are too quick to take their profits and they're too slow to cut their losses, in part because they want to make their profits real, but they don't want to admit their losses are real as well. And remember, at the very start of this discussion, I mentioned that a lot of these misconceptions come about because it's part of human nature, and it's also it goes against conventional wisdom. The word realized and unrealized has the word real in it. So it's like the English language is actually trying to trick you into thinking just because it's an unrealized loss, it's actually not real, it's unreal. So the misconception or the mistake that people make is actually built into the English word that we use. We think that we realize a profit, it makes it real. If we have a loss that's unrealized, then it's not real yet. So again, this is just one of those quirks of English and quirks of trading that you have to try to actively get your mind to fight back against. So the better way to think of this is if you look in your MT4 account, don't focus too much on your realized profits or losses above the line and your unrealized losses or profits below the line. You should be looking at your equity value. So your equity value is what your net deposits are plus or minus your trading P&L. And that will give you the accurate representation of whether you're doing well or doing not so well. And in most circumstances, it's actually that equity value that is actually the relevant consideration. So if you think about hedge funds and the performance fees that are owed to the hedge fund by investors. So quite often it'll be a 2 and 20 relationship or a 2 and 20 arrangement. So all that means is there's a 2% management fee and a 20% performance fee. So that 20% performance fee is not paid on realized profits. It's paid on all profits. So it's not like at the end of the quarter, before the performance fee is paid, all the traders at the hedge fund are thinking, well, how do we sell all of our winning positions so that we can realize these gains and get ourselves a good performance fee? No, of course not. What's happening is they're just going to look at the portfolio value at the end of the quarter, look at the profits, realized or unrealized, and pay the performance fee based on that. Okay. Again, you think about if you're thinking of refinancing your mortgage, let's say you bought your house for $2 million and you've been very unlucky and now it's only worth $1 million. Well, the next bank, when they're looking at your finances, they're not going to go, well, you bought this for 2 million and you haven't sold it yet, so you haven't actually realized this loss. So we're going to assume that this house is worth $2 million. Of course not. They're going to look at the current value of the house, which is 1 million, and they're going to base the amount they're going to lend you, they're going to base the interest rate, all the other terms based on the current equity or portfolio value, not based on whatever realized or unrealized loss you may or may not have. So that's just something to keep in mind. Again, just to finish off, unrealized profits and losses are still equally real. So an unrealized loss, an unrealized gain is just as real as a realized gain and a realized loss. I think we're going to finish off there. So again, thank you very much for taking the time to join us this evening. I hope you did find that engaging and interesting. I'm just going to give us a second and see whether we've got any questions. I can see a couple of comments in here, but I'll give us a little bit of time as well, because I know there's a little bit of lag here. Okay. Well, I think we can finish off there. Although I know some people do ask about what my background actually is, not my trading background, but my ethnic background as well. So I know a lot of you are from Southeast Asia listening tonight. My parents actually came from Malaysia to Sydney when they were in high school. A lot of people came from Malaysia in the 60s and 70s, and my parents were one of them. But I was born here, which is why I sound the way I do, and why I also can't speak any other language other than English. But yeah, I mean, I still celebrate Chinese New Year, that sort of thing. But yeah, so I think of myself as Australian, but my parents came here from Malaysia. Okay, so again, I hope you found this interesting. Again, I think these misconceptions are topics that are very under-discussed, but they're very important. If you really can get on top of them, I think it's something that will take you a very long way on your trading journey. So again, thanks very much, and hope to see you again soon.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.